Piketty's Capital in the 21st Century, Chapter 8. Two Worlds, Inequality of Labor Income approximately 50 minutes 5 parts voices. Equals primary lecturer, equals commentator / historical voice. Part 1. The Wage Question. Why is your pay what it is? Welcome back. We have spent several chapters now building our understanding of capital, what it is, how it accumulates, how the ratio of capital to income, beta, rises and falls across history. We have talked about the split between capital and labor as a whole, the share going to owners versus the share going to workers. But now Piketty makes a crucial move. He zooms in. He stops looking at workers as a single block and starts asking, within the world of labor income, within wages and salaries, how equal or unequal is that world? Because here is something that often gets lost in the big picture inequality debate. The inequality between a factory worker and a hedge fund manager is one kind of inequality, capital income versus labor income. But there is another kind of inequality that is just as dramatic and much less discussed, the inequality between one worker and another worker, between the nurse and the neurosurgeon, between the shelf stacker and the software engineer, between the cleaner and the chief executive. Chapter 8 is about this second kind of inequality, inequality within the world of labor, and it turns out to be every bit as revealing, every bit as politically charged, and every bit as historically shaped as the capital-labor split we have already studied. Let us begin with what sounds like the most natural question in the world. Why do some people earn more than others? That question sounds simple. It is not. Economists have been arguing about it for centuries, and they have produced several competing frameworks, each of which captures something true and misses something important. The oldest answer, and still the most influential in mainstream economics, is marginal productivity theory. The idea goes like this. In a competitive market, each worker is paid what they contribute to output. If hiring one more accountant adds 50,000 euros of value to a firm per year, the firm will pay up to 50,000 euros for that accountant. If it paid more, it would lose money. If it paid less, a competitor would poach the accountant with a better offer. So wages in this framework reflect productivity. You are paid what you are worth. Simple, clean, morally convenient, and substantially wrong, or at least substantially incomplete. Let us stress test the marginal productivity story with some real examples, because it has a certain seductive elegance that deserves to be taken seriously before it is dismantled. If you are a surgeon who performs a complex heart operation and that operation saves a life, the value you create is arguably enormous. Your salary, high as it is, might actually understate your marginal product. Fine, the theory seems to hold. But now consider a hedge fund manager who earns $50 million a year. What is her marginal product? She is managing money on behalf of pension funds and wealthy investors. She is making trades that, she claims, generate above-market returns. But here is the puzzle. Financial markets are, at least in aggregate, zero-sum. For every trade that makes money, a counterparty loses money. The total wealth in the system does not increase when one hedge fund manager outperforms another. Value is transferred, not created. So what is her marginal product to society? It is substantially lower than her salary. Her marginal product to her clients might be high, but that is a transfer from other market participants, not a creation of new value. And yet she earns $50 million. Marginal productivity theory, applied naively, cannot explain this. Or rather, it explains it only if we accept that what financial markets reward is identical to what society values. And that is a very large assumption. The gaps in marginal productivity theory become even more glaring when you look at cross-country comparisons. The median wage in the United States is roughly twice the median wage in France when expressed in the same currency and adjusted for purchasing power. Are American workers twice as productive as French workers on average? No, the difference in output per hour worked between the two countries is much smaller, and in some sectors, French workers are more productive per hour than Americans, partly because the shorter French working week means workers are often less exhausted. So if wages reflected productivity precisely, we would not see these large cross-country differences in median pay. What we actually see is that wages reflect a combination of productivity, yes, but also institutional factors, the strength of unions, the level of the minimum wage, the degree of labor market regulation, the social norms around executive pay, the bargaining power of workers versus employers. None of these institutional factors appear in the elegant mathematics of marginal productivity theory, but all of them appear in the actual data on wages. And this is Piketty's central insight in Chapter 8. The distribution of labor income is not the simple readout of a productivity machine. It is the product of social and political institutions. It reflects power. It reflects history. It reflects the outcomes of fights, sometimes literal fights between workers and employers, between different classes of workers, between skilled and unskilled, between men and women, between those with access to education and credentials and those without. The wage you receive is not a pure signal from the market about how valuable you are. It is the outcome of a negotiation, sometimes an explicit negotiation in a union contract, sometimes an implicit negotiation in the labor market as a whole, but always a negotiation, always shaped by relative power. And power, as we know, is not equally distributed. Let me give you a historical example that makes this concrete. Britain in the early 20th century. Domestic service was one of the largest occupations in Britain. Hundreds of thousands of women worked as housemaids, cooks, parlor maids, laundry women. They worked extraordinarily long hours, often 70 or 80 hours a week, with minimal days off for very low wages. Were they unproductive? No. The services they provided, clean houses, cooked meals, laundered clothes, were essential. Were they paid according to marginal productivity? Not even close. They were paid according to what the labor market for poor women in a society with limited alternatives would bear, which was very little. Then came the First World War. Women flooded into munitions factories and other industrial occupations that paid significantly more. The supply of domestic servants collapsed almost overnight. After the war, wages for domestic service had to rise to attract workers back. The marginal productivity of domestic servants had not changed. What changed was the outside option, the alternative available to poor women. Power changed, and wages followed power. The outside option. This is one of the most important concepts in understanding wage determination. Your wage in any given job depends not just on what you produce in that job, but on what you could earn elsewhere, what your next best alternative is. If your only alternative to this factory job is starvation, you will accept very low wages. The employer knows this. The employer uses this knowledge. If your alternative is another factory job that pays well, or your own farm that feeds you, or a state benefit that maintains a minimum standard of living, your bargaining position is much stronger. The welfare state in this light is not just a humanitarian program. It is a labor market intervention. It improves the outside option of every worker, which strengthens their bargaining position, which raises wages at the bottom. Which is precisely why capital owners and their political allies have historically fought so hard against robust welfare states, not out of fiscal conservatism alone, but because they understood, instinctively or explicitly, that generous benefits strengthen labor's hand in the wage bargain. And this connects directly to one of Piketty's most important data observations in Chapter 8. He shows that the compression of labor income inequality in the mid-20th century, the period when wage gaps narrowed significantly in most wealthy countries, coincides precisely with the period of rising welfare states, strong unions, and active minimum wage policies. And the subsequent widening of labor income inequality from the 1980s onward coincides with the erosion of all three: thinner welfare states, declining union membership, minimum wages that failed to keep pace with productivity growth. This is not coincidence, it is causation. The institutional architecture that had compressed wages was dismantled and wages diverged. The market did not make this happen. Politics made this happen. Let us be specific about the scale of labor income inequality we are talking about, because it is genuinely shocking when you put the numbers side by side. In the United States in 2024, the median full-time worker earns approximately $56,000 a year. The average compensation of the chief executives of the 500 largest American companies is approximately $17 million a year. That is a ratio of roughly 300 to 1. In 1965, that same ratio was approximately 20 to 1. The productivity of the average worker relative to the chief executive has not changed by a factor of 15. The institutional arrangements governing executive pay have changed. The norms have changed. The power balance in the boardroom has changed. In 1965, unions were stronger, shareholders were less assertive, and social norms around pay inequality were less tolerant of extreme dispersion. In 2024, unions are weaker. Shareholders demand short-term results that CEOs claim to deliver, and the social norm of extreme executive compensation has become so established it barely raises eyebrows. This is a political and social transformation expressed in wage data, nothing more, nothing less. Part 2: The minimum wage, skill, and the great divergence. Let us talk about the minimum wage. Because in the inequality debate, it is simultaneously one of the most straightforward policy tools available and one of the most politically contested. And Piketty has specific and interesting things to say about it. The minimum wage is, at its core, an institutional floor, a political decision that regardless of what the market would otherwise determine, no worker will be paid less than a specified hourly rate. Standard economic theory warns that setting a minimum wage above the market wage will cause unemployment. Basic supply and demand. If you raise the price of labor above its market value, employers will hire less of it. This is theoretically coherent, and empirically it is substantially not true, at least not in the ranges of minimum wage increases that have actually been enacted. The landmark studies of economists David Card and Alan Kruger in the 1990s compared counties in New Jersey and Pennsylvania after New Jersey raised its minimum wage. Employment in fast food restaurants, a low-wage sector, did not fall in New Jersey relative to Pennsylvania. If anything, it rose slightly. Card won the Nobel Prize in Economics in 2021, partly for this and related work. The committee was implicitly acknowledging that the real-world data on minimum wages does not confirm the simple textbook story. The textbook story turned out to be wrong about a lot. Why does the textbook story fail? Because it assumes labor markets are competitive, that workers can easily switch between employers, that employers are price takers who cannot influence wages. None of this is fully true, and in low-wage sectors it is spectacularly untrue. In many low-wage labor markets, workers face what economists call monopsony. Monopsony is the labor market equivalent of monopoly. One buyer, or a small number of buyers, of labor in a given market. If you are a home care worker in a rural county, there may be only 2 or 3 employers who hire home care workers. You cannot easily switch. You cannot easily move. Your children are in school here. Your family is here. The employers know this. They use it. They pay wages below what a genuinely competitive market would produce. In this situation, a minimum wage does not reduce employment. It corrects a market failure. It forces the monopsonist employer to pay wages closer to what a competitive market would produce. And the evidence suggests this is the normal condition in many low-wage labor markets, not the exception. The monopsony insight reframes the entire minimum wage debate. It suggests that the choice is not between a market-determined wage that reflects genuine productivity and a politically imposed distortion. The choice is between a wage set by employers with market power, which is already a distortion, and a wage floor that corrects that distortion. In both cases, wages are set by power. The question is whose power, the employers, or the democratic state acting on behalf of workers? And this framing should remind us of something. When people argue against the minimum wage on the grounds that wages should be set by the free market, they are often, inadvertently or deliberately, arguing that wages should be set by employers with market power. That is not the free market. That is just power without the inconvenience of democratic accountability. Piketty makes this point quietly but persistently throughout Chapter 8. The labor market is not a natural phenomenon. It is an institution, shaped by rules, and the rules can be written differently. Let me give you the American minimum wage story, because it is a masterclass in how political choices create economic outcomes. The United States federal minimum wage was introduced in 1938 as part of Roosevelt's New Deal at 25 cents an hour. It was raised repeatedly through the 1950s and 1960s. In real terms, adjusted for inflation, it reached its peak value in 1968 at approximately $12 in today's money. Then it was allowed to stagnate, not always cut directly, just not raised to keep pace with inflation or productivity growth. The federal minimum wage today is $7.25 an hour. It has not been raised at the federal level since 29. $7.25, compared to a peak of approximately $12 in real terms in 1968. If the minimum wage had simply kept pace with productivity growth since 1968, if workers had continued to receive the same share of productivity gains they received in the post-war decades, the minimum wage today would be over $20 an hour. Over $20, the actual federal minimum is $7.25. That gap between what wages would be if workers had kept receiving their historical share of productivity growth and what they actually are is one of the most vivid illustrations of what has happened to labor income distribution in America since the 1970s. The gap between productivity growth and wage growth. Let us dwell on this because it is central to Chapter 8. From roughly 1948 to 1972, productivity and wages in the United States grew together. When the economy became more productive, workers' pay rose to reflect that. The gains were shared. From roughly 1973 onward, the relationship broke. Productivity continued to rise. Wages for most workers stagnated in real terms. The gains from productivity growth went somewhere. They did not vanish. They went to the top of the income distribution, to corporate profits, to capital income, to executive pay. The pie got bigger, workers' slice stayed the same. This is the single most important fact in understanding American economic inequality over the past 50 years. And it is a political fact, not a market fact. Now skills. Because we cannot talk about labor income inequality without confronting the skills argument. This is the most common mainstream economics explanation for rising wage inequality. The story goes, technological change has increased the demand for high-skilled workers and reduced the demand for low-skilled workers. The computer replaced the typist. The robot replaced the assembly line worker. The algorithm replaced the travel agent. High-skilled workers, engineers, programmers, doctors, lawyers, are more valuable in a technology-intensive economy. They earn more. Low-skilled workers are less valuable because technology substitutes for them. They earn less. The solution in this framework is education. Train more skilled workers. Reduce the supply of low-skilled labor. Wages convert. It is a clean story. It is politically convenient because it locates the cause of inequality in impersonal technology rather than in human political choices. And it contains genuine truth. It contains genuine truth, but only partial truth. The skill-biased technological change argument runs into several problems when you look at the data carefully. First, if technology is the primary driver of wage inequality, you would expect to see similar patterns of rising inequality across all rich countries with similar technology. After all, the computer reached Germany and France the same time it reached America. But inequality rose dramatically in the United States and United Kingdom. It rose much less dramatically in France and Germany. And substantially, not at all in some Scandinavian countries. Same technology, very different inequality outcomes. Which means technology cannot be the primary explanation. The primary explanation must be the institutional differences between these countries, the differences in union strength, in minimum wage policy, in the social norms around executive pay, in the educational system. Technology changes the range of what is possible. It raises or lowers the demand for different types of labor, but the actual wages paid are determined by institutions operating within that range, and the institutions vary enormously. Second problem with the pure skills argument. Education has expanded dramatically in all wealthy countries over the past 40 years. The share of the workforce with university degrees is far higher than it was in 1980. If rising demand for skills were the problem and education were the solution, we should have seen wage inequality fall as educational attainment rose. It has not. In the United States, educational attainment has risen substantially. Wage inequality has continued to rise. The returns to education are high, yes, but the education premium has not been enough to reverse the overall trend toward inequality. Because the forces driving inequality, the decline of unions, the erosion of the minimum wage, the shareholder primacy culture, the weakening of labor's political power, are not problems that a university degree solves. You cannot educate your way out of a political economy that systematically extracts value from workers. There is a third problem, which is what Piketty identifies as perhaps the most fundamental. The skills argument assumes that wages reflect the value of skills, but the value attributed to skills is itself socially constructed. Consider two jobs that both require years of training and high levels of expertise. An investment banker and a nurse. The investment banker typically earns 5 to 10 times the salary of the nurse. Is the investment banker 5 to 10 times more skilled? In some technical sense, perhaps, but is their skill 5 to 10 times more valuable to society? The nurse keeps people alive and alleviates suffering. The investment banker facilitates the movement of financial capital, which activity is more socially valuable. Most people asked directly would say nursing, and yet the wages say investment banking. This reveals that wages do not simply reflect social value. They reflect market power. The investment banker works in a sector with high rents. Financial markets generate large revenues relative to the underlying economic activity they facilitate. The nurse works in a sector with enormous social value but limited market power. Healthcare is often a monopolistic employer. Nurses cannot easily switch employers, and their bargaining position is weak. And this brings us to what Piketty calls the social determination of wages. Wages are not primarily set by productivity or by skills. They are set by social norms, by institutional arrangements, and by the distribution of bargaining power. This is not a radical claim. It is the conclusion of a fairly careful reading of the evidence. And it has enormous implications, because if wages are socially determined, then they can be socially changed. Not just through market forces, but through political choices, through labor law, through minimum wage legislation, through union recognition rights, through norms about what constitutes acceptable pay ratios within firms. Germany introduced a national minimum wage only in 2015. Before that, it relied on collective bargaining agreements that covered most of the workforce. The outcome was broadly similar to having a formal minimum wage. Because the institutional infrastructure, unions, works councils, collective agreements, produced a floor even without a formal statutory minimum. When that institutional infrastructure weakened in the early 2000s, when the Hartz reforms expanded precarious employment, wages at the bottom fell. And the introduction of the formal minimum wage in 2015 helped reverse some of that fall. Institutions shape wages. Change the institution, change the wages. Let us close part 2 with a number that captures everything we have been saying. In 1965, the ratio of CEO pay to average worker pay in large American corporations was approximately 20-1. In 2023, it was approximately 320-1. Has the average CEO become 16 times more productive relative to the average worker than they were in 1965? Obviously not. What has changed is the institutional framework, the corporate governance norms, the composition of compensation committees, the ideology of shareholder value that incentivizes CEOs through stock options, the decline of countervailing worker power that might have restrained executive compensation. 320-1. That is not a market outcome. That is a political and social construction. And it can be constructed differently. Part 3. The Supermanager and the Rise of the Working Rich. Chapter 8 introduces one of Piketty's most memorable and important concepts. The supermanager. This is a figure who has become central to modern inequality, and yet is frequently invisible in the way we talk about economic unfairness. When people discuss inequality, they often reach for the image of the billionaire, the inherited fortune, the trust fund, the rentier living on clipped coupons. That image is not wrong, but it is incomplete. Because in the 21st century, and especially in America, a large and growing share of the very high incomes come not from capital at all. They come from extraordinarily high wages and salaries. From the supermanager. Who is this person? A corporate chief executive earning $20 million a year, a Wall Street banker earning $15 million in total compensation, a senior partner at a consulting firm or law firm earning $5 million, a top pharmaceutical executive, a prominent media figure with a lucrative contract. These are people at the very top of the labor income distribution. They are not in the traditional sense capitalists. They work, they have jobs, they receive salaries and bonuses. But their incomes are so large that they can save enormous sums, which means they rapidly accumulate capital, which means they transition from being purely labor income earners to being both labor income earners and significant capital owners. The supermanager is the bridge between labor income inequality and capital income inequality. This is a genuinely new development in the history of economic inequality. In the Belle Epoque, in the world of Downton Abbey and Proust and Jane Austen, the wealthy were wealthy because of inheritance, because of capital. Earned income salary was associated with the middle class, the professional, the doctor, the lawyer, the civil servant. They were comfortable, but they were not rich in the way that the landed aristocracy or the great industrial fortunes were rich. The truly wealthy did not need to work. That was the point. That was what distinguished them. Now something interesting has happened. The top of the income distribution in America is populated significantly by people who do work, who have very prestigious, very demanding jobs, who went to the right universities and climbed the right corporate ladders. The working rich. And their emergence has changed how we talk and think about inequality, because it is much easier to justify a high income as the reward for talent and hard work than as the consequence of being born into money. The supermanager wears the moral clothing of the meritocracy even when, as Piketty argues, the actual level of their compensation bears little relationship to any objective measure of their marginal contribution. Piketty is scathing about executive compensation, carefully, empirically scathing. He looks at the evidence on whether executive pay tracks corporate performance, and he finds the relationship remarkably weak. Studies of executive compensation consistently find that CEOs are paid more in sectors where the average executive is paid more, regardless of the specific firm's performance relative to its peers. They are paid more when their industry happens to perform well due to external factors, a commodity price rise, a regulatory change, that have nothing to do with their decisions. And they are paid well even when their firms perform badly, because the downside on compensation packages is typically limited by generous severance arrangements. What chief executives have become very good at is setting their own pay. The compensation committee of a corporate board is typically composed of other senior executives from other companies, who have a shared interest in setting generous pay norms, because the norms set for one executive become the benchmark for others. It is a small world. People on compensation committees are often personal friends of the executives whose pay they are setting. They attended the same universities. They belong to the same clubs. Their children go to the same schools. The social pressure to be generous is enormous. The countervailing pressure from shareholders, from workers, from the public has been historically weak. What happened in the 1980s that unleashed executive pay? Several things simultaneously. First, the ideology of shareholder value. The economist Milton Friedman had argued in 1970 that the social responsibility of business is to increase its profits, not to worry about workers or communities or the environment, just maximize returns for shareholders. This became the dominant ideology of American corporate governance from the 1980s onward. The practical implementation was the stock option. Instead of paying executives purely in salary, companies began paying large portions of compensation in the form of options to buy company shares at a fixed price. The theory: if executives own shares, they think like shareholders. They focus on the share price. The interests of executives and shareholders align. The practice: executives became enormously incentivized to push the share price up in the short term, even at the cost of long-term investment, even at the cost of worker wages, even at the cost of research and development. And when they succeeded in pushing the share price up, by cutting costs, by buying back their own shares, by financial engineering, they captured the gains. When they failed, the options simply expired worthless. The downside was limited. The upside was essentially unlimited. Share buybacks deserve a special mention here, because they represent one of the most naked examples of how the institutional framework of modern capitalism channels money toward capital owners and away from workers. A share buyback is when a company uses its profits or borrowed money to buy its own shares on the market. This reduces the number of shares outstanding, which mechanically increases earnings per share, which pushes the share price up, which enriches shareholders, and which triggers the value of executive stock options. In the United States, share buybacks were largely illegal until 1982. The Securities and Exchange Commission ruled them permissible under a new safe harbor rule, Rule 10b-18, in that year. Since then, American corporations have spent trillions of dollars buying back their own shares. In 2022, American companies spent approximately $900 billion on buybacks. $900 billion that could have gone to worker wages, to research and development, to capital investment in new capacity, to lower prices for customers. Instead, it went to enriching shareholders and triggering executive bonuses. This is not a market outcome. It is a regulatory choice made in 1982 by a government agency that has not been revisited. Let us cross the Atlantic. Because the supermanager phenomenon is not equally present in all wealthy countries, and the difference is instructive. In France, Germany, the Netherlands, and Scandinavia, executive pay has risen since the 1980s, but it has not risen anything like as fast as in the United States and United Kingdom. The ratio of CEO pay to average worker pay in Germany is roughly 50-1. In the United States, it is 320-1. Same technology, similar levels of corporate development, dramatically different pay ratios. Why? Partly because German codetermination laws give worker representative seats on supervisory boards, where compensation for top executives is discussed and decided. Worker representatives do not tend to vote for CEO pay packages of 300 times the average worker salary, strangely enough. Partly because French social norms have historically been less tolerant of extreme pay dispersion. France has experimented with public disclosure of pay ratios within firms, creating social pressure. And partly because in countries with strong unions covering most of the workforce, the wages of ordinary workers are higher to start with, which means the ratio between the top and the middle is smaller even if top pay is similar in absolute terms. There is also a cultural dimension that Piketty acknowledges carefully. Social norms about acceptable inequality vary across societies, and those norms change over time. In America in the 1950s and 1960s, the prevailing norm, reinforced by high marginal tax rates that made very high incomes less attractive, was that massive pay differentials within a single firm were unseemly. Company presidents earned well, but they did not earn 50 times what their secretary or their janitor earned. The social distance was real, but it was not of that magnitude. As marginal tax rates fell in the 1980s, the financial incentive to accumulate very high labor incomes rose dramatically. When the government takes 90 cents of every dollar above a certain threshold, there is relatively little point pursuing income beyond that threshold. You optimize for other things: power, prestige, perks. When the government takes only 28 cents, as it did after Reagan's 1986 tax reform, suddenly every additional dollar of compensation is worth much more after tax. The incentive to push for maximum compensation becomes powerful. And the norms shifted to accommodate the new financial reality. High executive pay became not just tolerated, but celebrated as evidence of success. Piketty's point is sharp. The change in tax rates did not just affect behavior at the margin. It changed the social norms around what was acceptable. Those norms, once changed, are slow to revert even if tax rates rise again. I want to bring this to a very contemporary example. Elon Musk's compensation package at Tesla. In 2018, Tesla's board granted Musk a performance-based compensation package worth up to $56 billion if he hit certain ambitious financial targets. He hit them. A Delaware court initially struck down the package in early 2024, ruling that the process by which it was approved was flawed. The board that approved it was too closely tied to Musk personally. Tesla then reincorporated in Texas and held a new shareholder vote. The package was approved again. $56 billion in compensation for one person. Is Musk uniquely talented? Yes, by most accounts. Is he the most important single contributor to Tesla's success? That is much more debatable. He has also benefited enormously from the work of thousands of engineers, factory workers, designers, and supply chain specialists. But the more important Piketty question is a system that produces compensation packages of this scale a well-functioning meritocracy? Or is it a system in which corporate governance processes have been captured by executives in ways that allow them to set their own pay far above any reasonable measure of marginal contribution? The answer matters, because that $56 billion does not come from nowhere. It comes from the gap between what Tesla's workers produce and what they are paid. And here Piketty connects labor income inequality back to capital inequality. The supermanager is not just a curiosity of labor market sociology. The supermanager is the mechanism by which the gap between the very top and everyone else in labor income is transformed into an even larger gap in capital income over time. An executive earning $20 million a year, even after paying significant taxes, can save several million dollars annually. After 10 years, they have accumulated tens of millions in savings and investments. After 20 years, those investments have compounded. They are now genuinely wealthy, wealthy in the capital sense, not just the income sense. Their children will inherit this capital, their grandchildren. The supermanager of today becomes the rentier of tomorrow, or more precisely, the rentier's ancestor. The two worlds of inequality, labor income inequality and capital income inequality, are not separate. They are connected by exactly this mechanism. High labor incomes beget capital accumulation. Capital accumulation begets high capital income, and the circle tightens. Part 4: Gender, Race, and the Structured Inequality of Wages. Piketty's Chapter 8 does something that is, for a work of mainstream academic economics, relatively unusual. It takes seriously the structured nature of labor income inequality. What do I mean by structured? I mean that wage inequality is not simply a dispersion of individual outcomes around some neutral mean, shaped purely by differences in skill and productivity. It is structured by social categories, by gender, by race and ethnicity, by social origin, by geography. The same level of skill and effort produces systematically different outcomes, depending on which social category you occupy. And those systematic differences are not the product of the market. They are the product of history, of discrimination, of institutional structures that embed past inequalities into present outcomes. Let us start with gender, because the gender pay gap is probably the most thoroughly documented form of structured wage inequality, and also the most persistently misunderstood. The raw gender pay gap, the difference in median earnings between men and women, in most wealthy countries is somewhere between 15 and 25%. Women earn on average between 75 and 85 cents for every euro or pound or dollar that men earn. The standard dismissal of this fact is, well, of course there is a raw gap, because women are more likely to work part-time, to take career breaks, to work in lower-paying sectors. When you control for all these factors, the adjusted gap is much smaller. This is true in a narrow technical sense. If you compare men and women doing exactly the same jobs at the same seniority level in the same sector with the same experience, the unexplained pay gap shrinks significantly. But this misses the point entirely, because the factors being controlled for are themselves the product of gender inequality. Women are more likely to work part-time because they bear a disproportionate share of childcare and elder care responsibilities. Why do they bear that disproportionate share? Because social norms and institutional structures, the length of parental leave offered to fathers, the availability and cost of childcare, the expectation that women are the primary carers, push them in that direction. Women are more likely to work in lower-paying sectors, partly because those sectors are lower-paying, in part because women work in them. The feminization of an occupation historically tends to depress its wages, not because women are less productive, because the social status associated with predominantly female occupations is lower. The nurse-teacher-secretary triad is the classic example. These are highly skilled, socially essential occupations. They require years of training. They demand high levels of responsibility. A mistake by a nurse can kill someone. A bad teacher can shape a child's entire trajectory. And these occupations pay relatively modestly. They are also predominantly female. Coincidence? Not remotely. The historical sequence is revealing. Nursing, for most of its history, was a vocation for women, paid accordingly, which is to say, poorly, on the assumption that women were supplementing a male breadwinner's income. In countries where nursing has become more gender-mixed and where unions have organized effectively, nursing wages have risen significantly, not because the job changed, because the social dynamics around it changed. Computing is the reverse example. In the early decades of computing, programming was largely a female occupation. It was seen as clerical work, like typing. As computing became central to the economy and pay rose, men entered the profession in large numbers, and the field became coded as male, the image of the lone male programmer in a hoodie, the brogrammer culture of Silicon Valley. The devaluation of predominantly female work and the revaluation of work when men enter it is a pattern so consistent across history that it requires a structural rather than an individual explanation. Iceland has done something radical. And by radical, I mean simply decided to take pay equity seriously in a way that most countries talk about but do not actually implement. Since 2018, Icelandic companies with more than 25 employees are required by law to obtain equal pay certification. They must demonstrate, not merely claim, that they pay men and women equally for work of equal value. If they cannot demonstrate this, they are fined, meaningfully fined, not symbolically fined. The result has been a real reduction in the Icelandic gender pay gap. Iceland consistently ranks as one of the most gender-equal countries in the world by the World Economic Forum's Global Gender Gap Index. It did not get there because Icelandic men suddenly became more enlightened. It got there because Icelandic politics made structural changes that altered the institutional framework within which wages are set. Policy, institutions, rules, the same factors Piketty identifies as the drivers of labor income distribution generally. Now let us turn to race, and specifically to the American case, which Piketty discusses as the most stark example of racially structured labor income inequality in a wealthy democracy. The racial income gap in the United States has persisted, in various forms, for the entire history of the Republic. At its most extreme before emancipation, the gap was absolute. Black Americans received no wages at all. They received no income. They were income for others. After emancipation, the gap narrowed but did not close. By legal discrimination, by exclusion from unions, by restriction to the lowest paid occupations, by geographical concentration in economically depressed regions. Today, the median black household income in the United States is approximately 60% of the median white household income. 60%. Some of this reflects educational differences. Some reflects occupational differences. Some reflects geographic differences. But when economists control for education, occupation, region, and experience, a significant unexplained gap remains. A gap that reflects discrimination, both overt and structural, both conscious and unconscious. Audit studies, where researchers send identical CVs with stereotypically black or white names to the same employers, consistently find that the CV with a white-sounding name receives significantly more callbacks. Discrimination is not a thing of the past. It is a measurable, documented, ongoing feature of American labor markets. The racial wealth gap in the United States is even larger than the income gap. The median white family holds approximately 8 times the wealth of the median black family. 8 times. Some of this is the accumulated effect of income differences over generations, but much of it reflects the direct legacy of specific historical policies that built white wealth and denied black wealth. The GI Bill of 1944 is one of the most important and least acknowledged examples. The GI Bill offered returning veterans low-cost mortgages, subsidized university education, and low-cost business loans. It was one of the most successful wealth-building programs in American history. It created the white middle class of the post-war era. But it was administered by local authorities who systematically excluded black veterans. The Veterans Administration was effectively segregated. Black veterans were steered away from suburban mortgages and university loans. The program that built the white middle class was deliberately withheld from black Americans. And the assets built by white GI Bill beneficiaries, the suburban homes, the university educations, the businesses, have compounded for 70 years. The children and grandchildren of white GI Bill beneficiaries inherited those assets. The children and grandchildren of black veterans, excluded from the program, did not. This is how historical discrimination transmits into present-day capital inequality, through exactly the mechanism Piketty describes: compound accumulation over generations. Except here the compounding is not just of wealth, it is of injustice. And this brings us to something that Piketty does not discuss in Chapter 8 as extensively as it perhaps deserves, but which is implicit throughout. The relationship between labor, income inequality, and social mobility. The justification most commonly offered for income inequality is meritocracy. Some people earn more because they are more talented, more educated, more hardworking, and their children might earn more too because they inherit those traits. This justification requires social mobility to function. If the children of the poor can rise to the top on talent and effort, and the children of the rich can fall to the middle on mediocrity, then inequality might be seen as fair, dynamic, a system that sorts people to their appropriate level. But social mobility in the United States is surprisingly low. Remarkably low, in fact, given how loudly the American dream is proclaimed. Research by the economist Raj Chetty and colleagues has shown that the probability of a child born in the bottom income quintile reaching the top income quintile in America is approximately 7 to 8%. In Denmark, the same probability is 12%. In Canada, it is 13%. The land of the American dream has lower social mobility than most comparable European countries. And Chetty's research has also shown that where you are born, literally which county, matters enormously for your economic outcomes as an adult. Some American counties have social mobility rates comparable to Denmark. Others have rates comparable to some developing countries, and the low mobility counties are disproportionately in the South, and they are disproportionately home to larger black populations. Geography, race, historical exclusion from wealth-building programs, these all operate together. Piketty connects all of this to what he calls the meritocratic illusion. The belief, widespread and politically powerful, that inequality of outcomes reflects inequality of merit, that those at the top earn their position through superior talent and effort, that those at the bottom are there because of inferior talent or insufficient effort. This is an illusion in two senses. First, the outcomes we observe are shaped by starting positions, by race, by gender, by geography, by inherited wealth, in ways that have nothing to do with merit. Two equally talented people, born into different circumstances, will have systematically different economic outcomes. Second, even if we correct for starting positions and measure only merit, it is far from clear that the observed wage distribution tracks merit in any meaningful way. The hedge fund manager earning $50 million is not 50 times more talented or 50 times harder working than the hospital consultant earning $1 million. They work in a sector with higher rents. They have captured more of the value they help move around. The meritocratic illusion is politically important because it provides moral cover for inequality. If the distribution is fair because it is meritocratic, then redistribution is unfair. It takes from those who deserve to those who do not. But if the distribution is shaped by luck, by birth, by structural discrimination, by rent-seeking, and by institutional power, then the moral case for redistribution looks very different. It looks like justice. Let us close part 4 with what should be a humbling observation. The labor income distribution in any given country at any given time is not the output of a talent sorting machine. It is the output of a deeply political process. A process shaped by who writes the labor laws, by who sits on corporate compensation committees, by which groups have access to education and which do not, by which groups face discrimination in hiring and which do not, by which workers have union representation and which do not, by what the minimum wage is and how often it is raised, by what the outside option of a low-wage worker is and how that is shaped by the welfare state. All of these are political choices. All of them can be made differently. The structured nature of wage inequality by gender and race is not natural. It is constructed. It is the accumulated legacy of specific historical decisions made by specific people with specific interests. And it can be deconstructed. Slowly, with enormous resistance from those who benefit from it, but it can be deconstructed. The history of the past century shows that it has been deconstructed, partially and imperfectly, wherever sufficient political will has existed to make it so. Part 5. What can be done? Institutions, education, and the limits of both. We have covered a great deal of ground. We have seen that labor income inequality is not primarily about productivity differences. It is about institutions, power, social norms, and political choices. Now the question that Chapter 8 ultimately drives toward: what, if anything, can be done? Piketty approaches this with his characteristic combination of empirical rigor and political caution. He does not want to promise what cannot be delivered. He does not want to dismiss what the evidence actually shows. And the evidence shows that institutions matter enormously. Countries with strong labor institutions, high minimum wages, comprehensive collective bargaining, generous welfare states have lower labor income inequality than countries without them. This is not a trivial observation. It is the central empirical finding of Chapter 8. The distribution of labor income is not determined by technology or by the laws of economics. It is determined by political choices, and political choices can be different. But Piketty also insists on being honest about the limits of institutional intervention, because there are real limits, and ignoring them leads to policy failures that discredit the broader project of reducing inequality. Let us talk about education. Because education is the inequality intervention that has the broadest political support. It appeals to progressives, who see it as expanding opportunity. It appeals to conservatives, who see it as investment in human capital rather than redistribution. And Piketty takes it seriously, while also being honest about its limitations. The case for education as an inequality-reducing tool is genuine. Access to quality education is distributed extremely unequally in most societies. Children from wealthy families have access to better schools, to private tutoring, to enriching extracurricular activities, to social networks that open doors. Children from poor families often have access to underfunded schools, to teachers who are stretched too thin, to environments where educational attainment is not culturally prioritized because it has historically not paid off. Improving the quality of education for children from disadvantaged backgrounds would, over time, reduce the extent to which starting position determines outcome. It would make the meritocracy somewhat more real. And the evidence suggests it works. The Perry Preschool Project in the United States in the 1960s and 1970s followed low-income black children who received high-quality early education. Decades later, those children had higher earnings, lower incarceration rates, better health, and more stable families than a comparison group who did not receive the program. The returns to high-quality early childhood education for disadvantaged children are among the highest of any policy intervention. James Heckman at the University of Chicago has estimated returns of 7 to 12% per year across the lifetime of the program. So education works. High-quality early education for disadvantaged children pays back enormously. And yet we systematically underfund it. In the United States, school funding is largely tied to local property taxes, which means wealthy districts have excellent schools. Poor districts have underfunded ones. The richest school districts in America spend 3 to 4 times as much per pupil as the poorest. In Germany, school funding is more equalized across regions, though gaps remain. In Finland, the most celebrated education system in the world, funding is highly equalized, and teachers are among the most respected and well-compensated professionals in society. The Finland comparison is instructive because it demolishes one common excuse. Defenders of unequal school funding sometimes argue that money does not matter in education, that it is culture, motivation, family structure that drive outcomes, not resources. In Finland, resources are high and equitably distributed. Outcomes are excellent and equitably distributed. The argument that money does not matter in education is most vigorously made by people who have ensured that their own children attend very well-resourced schools. It should be taken with appropriate skepticism. But here is where Piketty introduces his crucial caveat about education as a solution to inequality. Education can reduce inequality of opportunity. It can make the starting positions less unequal. But it cannot, by itself, change the institutional framework that determines how wages are set once people enter the labor market. If we improved educational equity dramatically, If every child had access to the same quality of education regardless of family income, we would still need unions, minimum wages, labor market regulation, and progressive taxation to prevent the distribution of outcomes from becoming massively unequal. Why? Because even if everyone is equally educated, employers still have market power in many labor markets. Even if everyone is equally skilled, some sectors still generate much higher rents than others. Even if meritocracy were real, the returns to different types of merit would still be set by institutional structures, not by some neutral productivity measuring machine. Education improves human capital. But human capital alone does not determine wages. Institutional power does. And here is a thought experiment that makes this vivid. Imagine we dramatically expanded university education. Every young person gets a degree. What happens to wage inequality? If educational credentials are the scarce good commanding high wages, and we make those credentials universal, the premium on having a degree falls. The degree becomes the new high school diploma, necessary but not sufficient for a good income. And the signal of high productivity shifts to elite university degrees. Harvard versus State University, Oxford versus former Polytechnic. Which is roughly what has happened over the past 40 years. University education has expanded dramatically, and the premium has shifted to elite universities. And access to elite universities is highly correlated with family income. The credential race is, to a significant extent, a race to maintain positional advantage. The winners keep moving the finishing line. This is not a reason not to expand education. Expanded access to education has real and substantial benefits for individuals and for society. But it is a reason not to believe that education alone can solve inequality. The institutional framework of the labor market must also change. Let us talk about some specific institutional interventions that Piketty endorses, explicitly or by implication, in Chapter 8. First, a significantly higher minimum wage. The evidence strongly supports the idea that minimum wages at the levels prevalent in most wealthy countries have not caused significant unemployment, and that they have meaningfully raised incomes at the bottom. The United States could raise the federal minimum wage to $15 or even $20 an hour, as several states and cities have done, without the employment catastrophe that critics predict. The real question is not whether minimum wages cost jobs. It is whether the gains to low-wage workers from higher pay outweigh the losses from somewhat reduced employment, and the evidence strongly suggests they do. Second, restored collective bargaining. Union membership in America has fallen from approximately 35% of the private sector workforce in the 1950s to under 7% today. This collapse did not happen because workers chose to leave unions. It happened because of deliberate legal, regulatory, and corporate strategies to prevent unionization. The National Labor Relations Board process for union recognition is slow and easily gamed by employers. Workers who try to organize face termination at rates that are nominally illegal but practically unstoppable. Reforming labor law to make union organizing genuinely possible again, rather than theoretically possible but practically very difficult, would be one of the highest return inequality reduction policies available. The evidence from countries with high union coverage is clear. Unionized labor markets have lower wage dispersion. Full stop. Third, pay transparency. This is simpler than it sounds and more powerful than it seems. In most American firms, discussing your salary with colleagues is not formally prohibited, but is strongly discouraged. Workers often do not know what their peers earn. This information asymmetry systematically advantages employers. If you do not know what others earn, you cannot effectively negotiate. You cannot identify discriminatory pay gaps. You cannot build coalitions to demand better wages. Several countries have introduced pay transparency requirements. Norway has made salary information publicly available. Denmark requires employers to report average pay by gender and occupation. Iceland, as we discussed, requires equal pay certification. The effect of transparency is consistently to reduce gender pay gaps and to compress the overall wage distribution. Because information is power, and in the labor market, employers have historically had more information about wage levels than workers. Transparency corrects that asymmetry. Fourth, and perhaps most controversially, pay ratio limits or incentives. Several countries and some corporations have begun experimenting with caps or tax incentives related to the ratio between highest and lowest pay in a firm. Switzerland held a referendum in 2013 on a constitutional initiative that would have capped CEO pay at 12 times the lowest salary in the firm. It was rejected, but the debate was serious and the margin was not overwhelming. The United Kingdom now requires large companies to publicly disclose their CEO to median worker pay ratio. The disclosure requirement alone has created some social pressure. Boards are at least aware that extreme ratios will be publicized. Whether that awareness has meaningfully constrained pay is less clear. But the principle is sound. If extreme pay ratios are primarily the product of social norms and institutional arrangements rather than productivity differences, then changing those norms through transparency and regulation is a legitimate policy tool. It is not the same as confiscating wealth. It is changing the rules of the game within which wages are set. And changing the rules of the game is exactly what Piketty argues needs to happen throughout the book. Let us bring Chapter 8 to a close with a broader observation. Piketty frames Chapter 8 around two worlds. The world of the supermanager, where a relatively small number of people at the very top of the labor income distribution earn extraordinary sums that are rapidly converted into capital. And the world of everyone else, where wages have stagnated relative to productivity, where the minimum wage has eroded in real terms, where union membership has collapsed, where the outside option has been weakened by thinner welfare states. These two worlds coexist in the same economy, sometimes in the same building, the cleaner and the chief executive in the same office tower, the home care worker and the hedge fund manager in the same city. And the gap between them is not primarily a reflection of differences in talent or effort or social value. It is a reflection of institutional power, of who wrote the rules, and of whose interests the rules serve. This matters politically as well as morally. When people feel that the economic rules are not fair, that effort and talent are not reliably rewarded, that those at the top earn what they do not deserve while those at the bottom struggle despite working hard, that sense of injustice becomes politically explosive. It was explosive in the 1930s. It was expressed through the labor movements of the post-war era. It has been expressing itself in more troubling ways in the 2010s and 2020s, through populism, through the politics of resentment, through the appeal of leaders who promise to overturn a rigged system. The political instability of our moment is, in no small part, the consequence of the labor-income inequality that Piketty documents in Chapter 8. And the response to that instability matters enormously. One response is to restore the institutional framework that compressed labor-income inequality in the mid-20th century. Higher minimum wages, stronger unions, better access to education, more generous welfare states, pay transparency, corporate governance reform. These policies have a track record. They worked in the post-war decades. They continued to work in countries like Germany and the Scandinavian nations that maintained them. They are not magic. They have costs and limitations, but they are grounded in evidence. and they address the actual mechanisms that produce the inequality. Another response is to do nothing about the inequality while channeling the political anger it generates toward scapegoats, immigrants, minorities, foreign competitors, cultural elites. This response addresses none of the underlying causes. It does nothing to raise wages at the bottom. It does nothing to constrain executive pay. It does nothing to restore union power or fix the minimum wage. But it is politically powerful in the short term, because it offers the satisfying simplicity of a villain and a promise. The choice between these responses is one of the defining political choices of our moment, and it is a choice made not just by politicians but by citizens, by voters, by all of us who participate in the political process or fail to. Piketty ends Chapter 8 without drama. He presents the data. He draws the conclusions the data supports. He proposes the institutional changes the evidence recommends. And then he leaves it to us. As he should. Because the distribution of labor income is a political construction, and politics in a democracy is something citizens do, not something that is done to them. The two worlds of Chapter 8, the supermanager's world and everyone else's, are not natural phenomena. They are choices. Accumulated choices made over decades by legislatures, by courts, by corporate boards, by trade unions, by voters. Which means they can be different. If we choose to make them different. And if we understand, clearly and without illusion, what has made them what they are. That understanding is what Chapter 8, and indeed the whole of Piketty's great project, is designed to provide. The rest is up to us.